Welcome to TheoTrade. This is Don Kaufman, January 28th, 2022, doing the TheoTrade weekend update here on a Friday afternoon, your volatility survival guide. I believe it's absolutely imperative in this weekend's update that we discuss, obviously, some of the volatility that is hitting the marketplace. S&P's down just about 7.5% on a year-to-date basis. Nevertheless, if you take a look at, well, this week of trade, and that's one of the first things we are going to look at here, give you kind of a quick update, the S&Ps are going to finish mildly higher net on the week. How much higher? Well, we started the week right around the 4,400 level inside of the SPX. We're going to finish the week right here at about, 4,431. So again, a very mild rally. I got to tell you, if you saw the marketplace, of course, on Monday, you saw the huge reversal on Wednesday, you never would have dreamed that this marketplace could have finished the week higher. Hence, exactly why I'm going to be talking about, hey, what are some of the skills, some of the tactics that you need, to understand to survive in the midst of this volatility. Now, before I go too deep into, again, a volatility update or some critical levels in the marketplace, just want to give you a brief feel for some of the other major index products and some of the sector ETFs. So as I said, the S&Ps finished mildly higher, but if we take a look at the QQQ and apply auto expected moves, you're going to see the Qs finish the week massively unchanged on the week. The IWM, the little engine that could, the Russell, will finish the week ever so slightly lower. But here is what it really does kind of interest me on this front. There is almost like a fracture inside of the market when it starts to come to some of the sector ETFs. Like if you look at the financials, do you realize the financials will finish the week, well, strong on a relative basis? Go take a look at the energy sector. The energy sector actually broke to the upside of the expected move. Meanwhile, as I said, a lot of major tech stocks, are, well, either lower or flat effectively on the week, other than, of course, if you're Apple, which finished the week, well, higher, even outside the edge of the expected move. The reason that I think it's imperative to have that kind of discussion just about some of the sector rotations going on is, listen, what is incredibly strong, like financials, what has been really strong on a relative front, like energy, I would anticipate will actually start to fall into alignment with the broader S&Ps. And, maybe the NASDAQ doesn't necessarily get hit as hard in the coming days and weeks, and you start to see the financials take a little bit more of a hit. But again, the marketplace coming, ultimately together. So there's all kinds of ways to look at this and correlation coefficients and so forth. And again, we'll have that discussion here momentarily. Let's push aside what we think about sectors for a moment. Let's push aside what we even think about the S&Ps for a minute, I think the most critical aspect of understanding how to survive some of this volatility is to give you just kind of a brief volatility update. The first thing I'll say about this is game on. We're still in backwardation. And if you're unfamiliar with the terminology of backwardation, there's a couple of different ways to look at volatility backwardation. One of them can be to look at the VX, so what the volatility futures happen to be. And when you really want to look at the volatility futures, typically you got to get a little further out than 19 days. This 19-day volatility future is now going to be arbitraged into VIX. So it's a little bit short in terms of duration. So now we want to go about 40 some odd days out. But in this particular case, we're going to look again at a March expiration, the April expiration, May and June. And we are most definitely in a backwardation. And what that effectively means is short duration volatility is actually exceeding some of the back month volatility, which it just changes the nature of the marketplace in its entirety. How so? Well, it changes the nature of how a lot of very prominent market making firms, proprietary trading firms, and institutional firms would actually hedge off their risk. This, for the most part, makes it Mr. Toad's wild ride, right? And that's why I say, this is game on. As soon as we're in backwardation, you can see the two-sided trade. You can feel the two-sided trade. And what that basically means is S&Ps, you don't have to look any further than today on an intraday basis, all right? We're lower, dramatically lower in the pre-market. We spike on news. We sell off dramatically into the open. We rally. We sell off again. We rip into the close. Again, there's no great feel, if you will, for some of the intraday trade. And I stress this to you because if intraday right now, all right, is driving you crazy, listen, if you're effective and understand volatility, this is what you dream for. Like, you wait years for this kind of raging volatility, especially on an intraday basis. But just know that so long as we are seeing volatility backwardation, that we are going to see wild two-sided trade. We could be up 150 handles and flip around and end up the day, massively lower in here. Now, that volatility backwardation, it confuses a lot of people. And first of all, we're going to cruise over to the VIX and we're going to look specifically at the VIX options. The VIX options are undoubtedly one of the more convoluted products in the entire marketplace. When you look at VIX options, I'd be remiss not to mention the VVIX. The VVIX, what is the VVIX? It's the volatility index. The volatility index is still actually trading at the 132 handle, which is never land, because, north of 110 is an extreme level. Like 132 is just downright wild. And if you've seen, pretty much since the onset of, 2022, we've had all of one trading session where we've kind of been under a 110 VVIX. So volatility has obviously been raging throughout the course of this year. But there's a lot of implications to the option chain itself. What I want you to understand is simply this. A lot of people look at VIX and they say, sooner or later, VIX is going to go down. That's absolutely true. VIX does have reversion to the mean. But the reason that I'm actually bringing up VIX options is everybody looks at this and they go, oh, that's easy. If the VIX is going to go back down, I'm just going to take a little bit of a bearish trade in the VIX. But people, if you think the VIXs are going to be, back down, people, that's already priced in. And that's one aspect that a lot of people, they don't really get. Okay, that's what backwardation means is quite simply, when you look at VIX options, these 18-day options are actually priced, okay, from the Vol Futures, all right? These 45-day options, they're not priced off of this VIX, okay? The 109-day is not priced off of this VIX. It's priced off of the Volatility Futures. So if you're going to trade VIX options, you actually have to go back and forth, kind of toggle back and forth. And I'll give you a quick example. If you were to trade 45 days out, the March 15th expiration, these VIX options, okay, to trade these VIX options, you got to cruise over, all right, to the Volatility Futures, and you got to come out and scroll out here to the March, and they're trading 27.15. So the at-the-money options here are actually based on 27.15, not 27.66. Okay, so the further you go out in time, and again, I want to show this in the volatility, the further you go out in time, you realize even 110 days out, the May Volatility Futures are pricing 26.50. So when the VIX options to go out here all the way to May, all right, the at-the-money options are right around the 26.50 level. Be aware of that. I think it's absolutely critical. So everybody turns around and they go, yeah, that VIX will be down. Yeah, but it's already pricing some of that reversion to the mean in. So just please be aware of that. Next on the docket over here, okay, another, I think, great, indicator of some of the extreme nature of volatility right now would have to, of course, be the dollar. This is being used pretty much unequivocally by a lot of trading firms as like a duck and cover. In fact, there are a number of traders, of course, in Europe that are actually telling me, they're like, yeah, man, we're doing everything we possibly can, get out of the euro, get into the US dollar. When the proverbial risk hits the fan, okay, a lot of traders do not want to be caught in other currencies, so they're rushing into the dollar. All I'm trying to portray by this volatility update, we're still in backwardation, Okay, we're still seeing pretty incredible like flows into the US dollar. Today was largely unchanged. And I bring this up because if you're looking at today's rally, and again, this is a volatility survival guide, right? And if you're looking at today's rally and you're like, okay, we're waving the all clear. This is all clear. We can come out again. We can buy the dip. Except that volatility says otherwise. VIX options say otherwise. The dollar says otherwise. Everything is like highly, highly guarded at this particular point in time. All right, let's move beyond that because I think that the volatility update can get a little bit esoteric for some of you. Let's go to some critical levels. For that, we're going to jump into the S&Ps. First and foremost, 4211, okay, 4500, just even. We believe that those are some absolutely critical levels inside of the S&Ps. Okay, this 4211, okay, has been around for a substantial period of time. 4,500, and I'm going to box this in for a second, 4,500, that was a critical threshold that we just had, we hit back here in like early December, okay? When we actually hit right here at 4,500, that is when volatility exploded the first time. We pretty much came down to it, hit it again, right? Volatility didn't rage that much again the second time, but the third time was kind of the charm. Volatility, obviously, not only did we break through the 4,500, but volatility has taken off once again. The reason I'm bringing this into scope is that it's my belief that at this point, that 4,500 level, okay, might be a fairly critical kind of upside barrier. It's going to come into play. I'm going to mention it here momentarily. To the downside, 4211. Where does 4211, okay, even really stem from? Here's where we can actually open up even a slightly longer time frame. Let's go back like one full year, okay, and you will see that this 4211, all right, was people get into support and resistance considerably. I'm not going to go down that path. It's what I actually term a gravity point. It's a point to which there was probably considerable risk by some very major trading firms, and we kept gravitating right specifically into this level. And if you would, we actually skirted the 4211, skirted the 4211 back here last year, again shy of a year ago. Broke finally out to the upside, came back, touched it, and we've done this a multitude of times. Obviously, we came to 4212 on Monday of this week. So why am I bringing these particular critical levels up? All right, this is actually what I kind of call a volatility channel that we're in right now. Let's go to a 30-day 1 hour, and this should start to really resonate with some of you. Okay, when we broke through 4,500. Things got downright wicked inside of the S&Ps. At this point in time, we're in an incredibly tight volatility channel to where there isn't necessarily if you're looking at this and you're like, oh, the market finished higher today, right? That is inconsequential. And it has been throughout the course of the week. I mean, the bell just went off. Like, it didn't matter when the bell went off, but the bell went off. So what we're actually in, and I've dubbed this kind of and I've used this term before, it's kind of what I call the hurt locker. This is where retail can get absolutely smoked, ripped apart. I believe that the upside, okay, of this kind of present volatility channel, and by the way, this doesn't look like all that much, but we're channeling between roughly 4250 and roughly 4450 back and forth every single day of this week. I mean, this is Monday, this is Tuesday, this is Wednesday, this is Thursday, Friday. There hasn't been a day where we haven't come to the upside of the channel or the downside of the channel every single day. That's why I said it's not of consequence at all that we actually finished to the upper edge of this. Okay. However, with that being stated, I actually do think that what is likely to play out over here, a very short-term crack, possibly back to 4,500, followed by an incredibly steep decline directly into 4211. There's only one bottom line that I want to give you for this one. Not only do I believe we have to test 4211, I actually believe we have to cross through it. We have to see a little bit of what I term fear and loathing in this marketplace before any of this volatility could possibly subside. So I want to reiterate, my look at this is I'm inclined to believe that we're going to break to the upside before getting absolutely smashed back down into the 42.11 handle. From 42.11, I'll reassess at that point in time. But there's a high probability, I would believe, that we're actually going to cross through that. All right. The other aspect, and again, you can call it the Hurt Locker, Volatility Channel, anything you want. The other aspect, okay, we're in a high degree of correlation over here, which is, it's imperative to understand that that high degree of correlation, that ain't necessarily a good thing. Okay, and you're like, but we're correlated to the upside. Yes, because it's a relief rally right now. This is one of the hallmarks, if you will, of volatility. One of the hallmarks of volatility isn't necessarily this. It's the wild, okay, unforeseen, unforgiving up move. That, people, is the hallmark of volatility. Hitting 4,500, good. Do it. Let's get it done. Hit 4,500 and then just break lower. That would, again, be my assumption in the very near term for trade in here. All right. Let's move on and start to talk about a couple of tactics to kind of deal with some of the volatility. So, are you going to fight the Fed? Like, will you fight the Fed? There's been that age-old saying, don't fight the Fed. Well, right now the Fed is quantitative tightening. They're going to raise interest rates. One thing I want to bring to your attention: long and wrong could bring absolutely unbearable amounts of risk. When I say long and wrong, I'm simply saying, like, look, you go out here, okay, you're looking at something like the QQQ, you're like, oh man, the Qs haven't been down there, and what? In a matter of a couple of weeks ago, you do realize that all the sell side activity that we've seen here in the last month, we saw the exact same up move, which also took a month. The up move, well, the down move was just as fast. So are we there yet? Possibly not. I just want you to be aware that if you're caught long and we start to go into our precipitous decline, you better have an intimate, comfortability with whatever your risk happens to be. Next thing I want to come into play: stops. They're going to work, but they're going to work all too well in the midst of volatility. Effectively, if you're using stops, you're going to get taken apart. One of the things that people don't have respect for in the midst of volatility, first and foremost, you might be used to trading, and I'll just give you an example. Let's cruise over to like Apple or something. You may be used to trading 200 shares of Apple. But the volatility right now specific to Apple is almost double what it has been. So, and this is even after its earnings. So for the most part, you're looking at something like Apple. If you're using, stop orders, are you moving the stops twice as far as you normally would? Like if you normally used a stop that's like $2 out of the money, are you making it $4 out of the money? The next thing is, with twice the volatility, are you cutting your trading size in half? Most people tell me, oh no, you must think about volatility like, all of a sudden, I'm going too fast in this car. I need to downshift. Cut size, okay, if you're going to use stops. And again, I am not an advocate of stops, but if you're going to use them, however tight you normally would have stops, you have to double that range, because in a normal volatility fluctuation, you're getting twice as much price action as you were just a few weeks ago. All right, so long and wrong is going to bring unbearable risk. So people turn around, they go, I'm going to use stops. I mean, do you realize what stops would have done to you? Okay, this particular week, like, look at markets. 42.11, don't worry, 4,400. That's a 200-point move to the upside, like to a T. It's like exactly 200 S&P points, right? We sold off, we rallied back up. We sold back off, we rallied them back up. It has been, again, unbearable amounts of risk. Stops are going to rip you apart in a marketplace like this. All right, next thing I want to bring to your attention. Okay, as I said, long and wrong is going to bring unbearable risk. But at the same time, I've had a lot of emails, a lot of conversations with individuals right now. This is not the time to bottom fish. This is not a time to bottom fish. You go, what do you mean by bottom fishing? I know people are going to cruise around and they're going to look at a couple of stocks. Yeah, I want to get long. Look at Target's been down. It's been down a lot. Oh, Twitter. Oh, you want to see some really ugly stuff? Okay. Start looking at like anything in the ARK portfolio. Okay. Ooh, I don't care who you are. That has got to hurt. You look at stuff like Zoom. Listen to me. This is not a time to bottom fish. And for stocks that have been around quite some time, let's go look at something like, for instance, Microsoft. You're like, man, this is It's a pretty good opportunity to buy Microsoft. It hit this 280 level here. It hit the 280 level. It bounced over here. I beg you, before you try to bottom fish or sell puts to get long stock, I'm begging you, open up any 5-year chart. Okay? You look at a 5-year chart, I promise you, you're not buying anything right now because we haven't but scraped the surface of what could be some absolute monstrosity of volatility coming in, right? So please, any 5-year chart says so. Any 5-year chart will say, hey, you don't really want to go into this. Look at all your major tech stocks. All right. I mean, Amazon, this one really is scary because obviously, earnings coming out. This one's scary because, you're looking at a $3,000 product that looks almost bottomless to like $1,500. That'd be a 50% hit across the board. If you want to look at something like Netflix, and I think you actually should, this is the kind of damage that you can get inflicted upon you, okay, in any one of the major tech stocks. But it doesn't stop there. It just doesn't stop there. You look at stuff like Walmart and you're like, holy, okay. You want to start looking at something, really crazy? You pull up Costco, okay. Every 5-year chart, things look just out of control bid. So at this point, I'm not going to be out there bottom fishing. I don't even want to hear about but don't worry, it's going to pay a dividend. Okay. Listen, everybody's in those. Go look at XLU. I mean, come on. People are buying utilities at this point because it's got a 3.1%, yield. But you can see, okay, unequivocally, the last time we hit a patch of real volatility, that was utilities. What happened to them? They got decimated. And here we are once again. So any 5-year chart, the next time you think you want to actually buy something, look at it. All right, onward and upward from there. That was a warm, fuzzy thing that we just talked about. Spreads. Okay, if you want to take directional bias right now, when I say directional bias, you want to get long, you want to get short, listen, I get it. If you look at something like the QQQ and you want to get a little bullish in the QQQ, come on, just use spreads. Mitigate the risk. You could use $3 wide spreads, $4 wide spreads, okay, whatever does it for you. But the problem that a lot of people, they look at this and they go, I don't want to use spreads. It limits what I can make. Listen, my job here is to keep you alive in this business, right? My job is to keep you intact. My job is to make sure that you don't have, okay, hideous amounts of capital at risk. Right now, I cannot stress to you enough. Look at options, theoreticals, and Greeks and pull up implied vol. You want to buy a 30% or a 31% vol on a call, all right? Because the first thing that's going to happen is even if the markets rally, every call on this screen is just going to get smacked right in the face, okay, with a vol crush. That 30 volatility, by the end of if we rallied huge, next week, this 30 volatility is going to turn into a 23 volatility. That is not going to be good for anybody, especially you. Nevertheless, okay, you can even use some wider spreads. You're like, I want more upside potential. Okay, good. Use a $6 wide spread. $6 wide spread, realistically, I'd want to pay no more than about $3 for this one. But I think you get the point. Why? Why do you want to use spreads? I'm even going to pull up an $8 wide spread. $8 wide spread. Theoretically, you want to pay no more than about $4 for an $8 wide spread. Okay, so why a spread? And I'm actually going to take this over. So I'm going to analyze it for a second. We're going to analyze it to make one just very, very brief point. Okay, this spread that I'm displaying to you, it has directional risk. There's almost no gamma, there's almost no theta, and there's almost no volatility exposure. So net, all you have in a spread is directional risk. And that's what you're trying to do anyway. If you want to get long, okay, that's great. But if you want to get long and you're wrong, you're limiting what you can lose to $4. You're limiting all of the volatility exposure. In fact, on a spread, when the volatility goes down, it's actually beneficial on the spread. Spread your risk in every way, shape, or form. Even if you want to just take shots and buy out of the money spreads, spreads are going to be critical for those of you that want to take directional bias. Okay, I'm also going to throw this in over here. If you are so inclined to sell options premium is phenomenal in this kind of volatility. It is. It's absolutely incredible in this kind of volatility. But you have to know what you're doing. You have to know how to mitigate that risk. Last but not least, if you need a hedge, a very short-term hedge, you can use, and this is something I cover live on TheoTrade, but you can actually use deep in the money puts in stuff like the spiders. How deep in the money do you want to go? Typically want to go to about an 85 delta. A deep in the money put is, for the most part, it's like a synthetic short stock position. Come in here, again, this is a deep in the money put, and what a deep in the money put will do is it'll actually give you, all right, risk mitigation to the amount. Like if you buy one put in the spiders, you know, spiders are a $441 product, and buying one put is the equivalency of 100 shares. So you're giving yourself, for the most part, about $44,000, okay, of risk, what? Mitigation. So if you're long, you know, meaning you own like a $200,000 portfolio, you realize you could buy one deep in the money put and offset your risk just for the next 7 days, right? For the low price of like, you know, 16 or 17 bucks. You go, I don't want to lose 16 or 17 bucks. I didn't say you were going to lose it. That's actually your hedge, okay? Again, there's much more to that hedge. I'll explain that throughout the course of this coming week here on TheoTrade. Last but definitely not least, on this weekend's update, the SPX. There's one real standout here again. I didn't cover this during the portion of volatility. Maybe I should have, but a moment ago we were talking about, you know, a volatility update. Well, one of the things I think you have to be mindful of is that this past week that we were just in, all right, we had roughly, all right, $150, okay, expected move. That was this past week. We had hit the lower edge of the expected move. We came back up. We came back down. We came back up again. I mean, we were every ounce of $150 and then some. So you see this rally that we had specifically today, except raggy, we are still sitting on $137 of expected move in the coming week, which implies only one thing. Get ready to rumble even some more, okay? The volatility will not go quietly off into the night. Hence, why I'm giving you your volatility survival guide. I'm going to be covering this in extent throughout the course of this next week here, live on TheoTrade. I'm on first thing in the morning when the bell goes off. I am live. I'm going to cover, again, as many volatility survival tactics as we possibly can. But at the exact same time, listen, you got to have these volatility tactics down, because if you can't handle what you currently have on, how do you think, okay, that you're going to prosper in this kind of volatility? Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.